there are a few more confirmations why Australian housing is going to take the turn south. And one of them is this Royal Commission that just wouldn't go away for the banks and the mortgage brokers, where banks are being roasted for their misconduct and their wrongdoings, and also the mortgage brokers selling mortgages to anyone that can fog up a mirror. And this is all going to change, and the bank and the lending industry and the banks and the mortgage brokers are going to have to get their house in order, in a sense where they're going to be more careful as to who they lend the money out, because they're in the spotlight. So to show the regulators that they are fixing their wrongdoings, they are going to tighten the criteria at the same time that the interest rates are going up. This is just hot off the press, the report. You must see this. It's only a minute and a half. So we got the Royal Commission update. We got the why the interest rates are going up and what that's going to mean for the mortgage holders. And then there's an article on New York real estate, very interesting, the state of condo market in New York at the moment, fresh and hot off the press.
Economical with the truth. That was the scathing assessment of Royal Commissioner Kenneth Hayne about what big banks tell customers about commissions paid to mortgage brokers. Questions over just whose interest mortgage brokers act in have reverberated through the $50 billion industry, with uncomfortable answers over fat fees and poor outcomes for borrowers. But the broking industry has hit back, insisting the customer comes first. Here's Daniel Ziffer.
For Australia's mortgage brokers, it's a question that could have a costly answer.
Who does a broker act for? Who does the customer think the broker acts for? Who does the lender think the broker acts for? Are there varying or varied answers at various steps? If there are, what are they?
Commissioner Kenneth Hayne's hearings had a recurring theme. Whom do they represent? The Peak Lobby Group insist they're for the customer and say the comparisons of the Royal Commission aren't fair.
It seems really disastrous. And you say, well, geez, what's going on there? It's actually not the case. The difference between proprietary channels and broker channels is about $32,000. We're not talking $100,000, $200,000. We're talking 32 grand. No one asked the borrower in that research, was it a bad outcome for them? That discussion wasn't had.
Consumer organisations say the evidence backs their research. Broker loans are larger and take longer to pay back.
They're paid to sell, and they get paid more if you borrow more or if you borrow with particular lenders. They present as a profession that's there to advise and help consumers, and consumers quite rightly think that they're there to help them.
Mortgage brokers, really, I mean, this is common sense, but then we all know that doesn't really exist out there. But you know, brokers are there to get the mortgages to people who are not supposed to get mortgages. And obviously, you're going to have to pay more to get something you're not supposed to get. So it's like a backdoor into getting yourself a mortgage. I mean, it's clear as day.
Uncomfortable evidence for the industry, the Commission found a previously secret submission from Commonwealth Bank CEO Ian Narev, admitting customers who use mortgage brokers are losing out through fees, interest and incentives. The Commonwealth Bank executive who fronted the Commission was forced to agree. Some customers are getting a bad deal.
The larger the loan, the larger the trailing commission.
That's correct, yes.
And the longer the period of the loan, the longer the period over which the trailing commission will extend.
That's correct.
I mean, how obvious is this? So they want you to get as much money, to borrow as much money as you can, and to struggle and pay off your mortgage, your loan, for as long as you can, to stretch it out and hopefully, ideally, struggle, meaning that you are only making minimum repayments. So this is like, it's in nobody's interest for you to be in a good financial standing.
Mortgage brokers typically don't charge borrowers for their services, but are paid upfront and trailing commissions from lenders. It's big business. In 2015, loans generated $1.4 billion in upfront commissions and a further $984 million in trailing commissions.
Who does the broker act for?
Commissioner Hayne will answer his own question in his report. Here's what the players say.
Well, as a business person, they're acting for themselves, but they act for the client when they're first doing the discussions with the borrower to ensure that they get product that meets the needs that they're looking for.
The broker may say they act for the client, but they're paid to act for themselves or act for banks or other lenders.
That complicated relationship could see more regulation when the draft report is handed down in September.
See the needs that they're looking for.
The broker may say they act for the client, but they're paid to act for themselves or act for banks or other lenders.
That complicated relationship could see more regulation when the draft report is handed down in September.
Yeah, that lady absolutely calls it and puts it in simple terms. Every time she spoke in that clip, she just said pretty much what everybody was thinking, what was on everybody's minds. And the report ended saying that there's no doubt going to be more regulation, so we know what that means. The next clip is a very short one, telling us why the interest rates seem to be going up and what that's going to mean for borrowers.
Some potentially worrying news for people with home loans here in Australia. We've seen interest rates around the world increase. How quickly will we feel the pinch? So it's quite a convoluted answer, unfortunately, but we'll go through it very quickly. We know that at the moment the US is increasing rates. We've seen that. They're issuing new debt as well from their government. All that has actually pushed yields higher. So their rate is now quite high. It's actually risen for the last 40 days in a row. If we bring it back to an Australian-centric point of view, it affects us here as well. Our short-term funding markets, which is the bank bill swap rate, which you would have heard in the Royal Commission, is actually now at a 2.5-year high. It's wiped out the 50 basis points the RBA has put out back in May and August 2016. It therefore means that it's over the short term, banks are going to find that their costs of borrowing are more expensive, and that can hit you and I as a mortgage holder. It means they may have to move interest rates to cover that cost. So your home loan rate actually might go up this year, even though the RBA doesn't move because funding's actually increasing. It's quite a conundrum and something that is building further and further. So today was a 35th consecutive day, and it's actually a record streak. Some worrying news there for those people watching those interest rates. Evan Lucas, thanks for your time. Thanks, Gary.
I will. There's nothing to add to that. Pretty much what I've been saying all along is that no matter what the Reserve Bank of Australia does, if the interest rates on the international money markets go up, which they are, there's not very much anyone in Australia can do about it. So we'll be stuck with these high housing prices and tight credit conditions, I suppose. And last but not least, let's go international. This is the state of New York real estate. In particular, this article, very short article, talks about the condo market. So this is from ArmstrongEconomics.com. So the reader writes in, Mr. Armstrong, I listened to you perhaps a bit too late. I put my condo on the market here in New York City and nothing for 6 months. The realtor said they have never seen buyers disappear so fast. Is there still hope for those of us trapped in the Big Apple? And the answer he gave to that was real estate in New York has collapsed 25% basis the number of sales, but by the end of first quarter. Sorry, but you may have to just lower your price until you find a sucker. Keep in mind that as interest rates rise, banks will tend to run away from mortgages very fast. The last crisis was real estate. They will be more reluctant with real estate than any other sector going forward. If funds for mortgages dry up, prices crash. I'll leave you with that thought. Thank you, everybody, and we'll talk to you in the next video.